When it comes to buying whole life insurance that's optimized for cash value accumulation, there are a number of different design tweaks that we as agents use to ensure that the policy will be set up to optimally accept all of the premiums that the client wishes to put into the policy. And the way that we go about doing this does vary from company to company, and that can cause some confusion because it will result in things looking a bit differently as we go from company A to company B. However, there are certain ways that insurance companies do approach this process that are better than others, and there are some that are downright terrible. So today, I want to warn you about one of the design features that some insurance companies use for the purpose of designing whole life insurance to enhance its cash building capabilities that might put you in a big pickle if you're not careful. So at issue is the term rider that we use to increase the allowable premium that can go into the policy. These riders come in a bunch of different flavors, and the one at issue here that causes the greatest amount of problems is the level term rider with a specific expiration date. So this looks a lot like the standard term insurance that most of you would go out and buy if you were in the market for life insurance and decided that you wanted term insurance. These have a specified death benefit with a specified expiration date. They generally look something like it will last for 10 years or 15 years or 20 years. And correspondingly, with that death benefit that goes, for example, 20 years, you have a specific premium that will never change. When it comes to a whole life policy design, this term rider is added on top of the whole life death benefit, again, to increase the allowable premium that you can put in there, mostly with what we call a paid up additions rider to enhance the cash value accumulation of the whole life policy. But these terminal, I'll call them term riders, have a bit of a problem when it comes to the tax code compliance that we need to follow suit with in order to ensure that you have a life insurance policy on your hands and not what we call a modified endowment contract. You want the whole life insurance policy because that comes with a boatload of tax benefits that you would love to take advantage of as it relates to distributing money from the policy and ensuring that those distributions remain tax-free. If your policy is reclassified as a modified endowment contract, you lose a whole bunch of those tax benefits, and the whole thing becomes much less a good deal for you. So I'm going to detail why it is that this specific term rider approach is bad news and where the potential pitfall lies. But before we get into that, I think it's important that we have a base understanding of how all of this works before we jump right into how it becomes a problem for you. Okay, so I want to start with a statement of fact when it comes to cash value life insurance policies and how the payment of premiums affects the policy relative to the death benefit. So for any policy that has cash value that is in existence, you have, of course, the death benefit. And correspondingly, you have the premium that is required. But alternatively, you have the maximum premium that is allowed. And this number is going to be greater than this number. We oftentimes refer to this premium, this max premium, as the MEC premium. It stands for Modified Endowment Contract. You may also hear it referred to as the 7-pay premium. I want to look at an example that kind of gives you some numbers to quantify how this might work. So let's say that you have a whole life policy that has a $1 million death benefit. And the maximum allowable premium for that is $25,000 per year. So what that would look like is you have a $1 million death benefit and you can put up to $25,000 into the policy each year and not create a modified endowment contract. It's important to understand something at this point. So the modified endowment contract premium, the max premium that we can go into the policy, is generally defined as the amount of money that would be necessary to satisfy all of the guaranteed elements of the insurance contract paid into it over a 7-year period. So put very, very simply, if you buy $1 million whole life policy, it's going to have a premium. Let's say that $1 million whole life policy has a paid up status achieved at age 100. What the insurance company has determined is this is the amount of premium we need from you to ensure that you will pay for all the guarantees that we're going to make to you from now to your age 100, however many years that's going to be. That's where the premium comes from. The modified endowment contract, on the other hand, is saying, all right, for the same contract, same benefit, there is a number that you could pay over a 7-year period that would also satisfy all of the contractual guarantees of this contract. And whatever that number is, that's the amount that you cannot go above. Otherwise, you will create a modified endowment contract. So having said that, the area of common stumble for people is they assume then that with this policy, we have years 1, 2, 3, 4, 5, 6, and 7. And if we pay this $25,000 amount in each one of those 7 years, we will not violate the modified endowment contract. And all of that is true. But what happens at year 8? Can we just go sky is the limit on premium payments? Sadly, there are companies that have said yes, and they're very wrong about that. What technically happens is the modified endowment contract rules, as they are stipulated in the U.S. tax code, allow for this maximum premium to be put into the policy over a 7-year time frame. And technically speaking, if you reach the end of the 7 years, you have satisfied all the premiums that are necessary for guaranteeing the features of the policy, you would technically need to stop. You can't put any more premium there, otherwise you'd have a modified endowment contract. But practically what happens is a material change. Material changes are somewhat varied, and they're not the most perfectly defined element of the tax code, but there are two very important things that you can do that would absolutely, undeniably cause a material change to a life insurance policy, specifically a whole life insurance policy. One is adding a rider to it. The second one is increasing the death benefit. And this happens to a lot of whole life policies, somewhat unwittingly at the hands of most policyholders. So if you have a paid up additions rider on your whole life policy, or you're using the dividend option to purchase paid up additions, you will increase the death benefit on your whole life policy, and you will, by point of fact, create a material change. Every time that a material change happens on a whole life insurance policy, it resets, or rather begins another 7-year clock. So at year 8, if the death benefit has increased at any one of these 7 first years, we begin a whole new time frame of 7 years for years 8, 9, 10, 11, 12, 13, and 14. So we're not out of the proverbial woods here. We are just beginning another time period of another 7 years with another maximum allowable premium. Technically speaking, because of the increase in death benefit, lots of times the maximum allowable premium doesn't change very much. But there are times that it could go down. And the one thing to understand is that every time you pay a premium to an insurance company, they will test the policy for modified endowment contract or 7-pay compliance. So if you've paid too much, they will let you know. It's not something you're going to accidentally do and find out 5 years from now that, whoopsie, you have a modified endowment contract. So after the first 7 years, it is possible to find out year by year by year what the maximum allowable premium is into the policy, so you don't make a mistake and pay too much. But even if you do, it's relatively easy to get the money that you overpaid in that year, that's important to remember, back and not create a modified endowment contract. The extremely important thing to understand here is if you create a material change, you begin a new 7-year period, you are still subject to the modified endowment contract rules as you pay subsequent premiums beyond year 7. Now, let's talk about death benefit reductions, because this is where things get very interesting. We're going to use our same example where we have a $1 million death benefit and we have a max premium of $25,000. Let's say that in years 1, 2, 3, and 4, you pay that $25,000. year 5 rolls around and something happens. Something causes you to reduce the amount of premium that you're going to put into the policy. It comes out to $12,500, and you decide at that point, hey, that's the most I'm ever going to be able to put into this thing moving forward. Things have changed, and that's it. So, now that I know permanently I'm not going to put more money into this policy, perhaps it makes sense to drop my death benefit down in order to make sure that I have the leanest policy possible. So if we were to reduce the death benefit by $500,000 and have, moving forward, a $500,000 death benefit, that should correspond to a $12,500 maximum premium. The problem is that if you make that change in year 5, the tax code says that the new maximum premium resulting from the death benefit reduction is the maximum allowable premium in all years retroactively back to year 1. So if you made any premium payment in years 1, 2, 3, or 4 that were in excess of $12,500, you will have violated the modified endowment contract test, and you will now have a modified endowment contract on your hands. This $25,000 payment that you have made is going to violate the test. It doesn't matter that you made it in years 1, 2, 3, and 4. You could have made it in year 3 and paid something less in years 1, 2, and 4. The fact that you made a payment in excess of $12,500 in any of the subsequent years, any of the previous years to year 5, means that you now have violated the modified endowment contract. So obviously the advice at this point would be, we're not going to make this reduction. We're going to stick with this $1 million until we get to year 7. And then we will entertain the possibility of a death benefit reduction, knowing that the maximum moving forward is $12,500. Now, let's talk about one of the key designs to optimizing the cash value of a whole life policy, the term blend, as we've always called it. When we're looking to optimize cash value accumulation of a whole life insurance policy, 9.9 times out of 10, we are looking to mix term insurance with whole life insurance. So there's going to be 2 aspects of the death benefit. We're going to have the whole life component, and we're going to have the term component. And again, I mentioned earlier that the term piece, this can vary considerably. The one that we're most at issue with is this level term idea that has a definite expiration date. So this blend varies from company to company in terms of what's allowable. I don't want to get into the specifics of what is the best blend for all cash accumulation of all whole life policies. There is not one right answer. It's circumstantial, dependent on the company and what best matches the individual circumstances for what they're trying to do and the time frame they're trying to do it. But that aside, I want to speak to this level term rider with a definite expiration date. So let's use our $1 million example from above as our death benefit. It's going to have a max premium. That's going to be $25,000. And for the sake of this example, let's say that this $1 million breaks into 2 components. It's got a $250,000 whole life death benefit and a $750,000 term rider that is good for 20 years. Obviously, for the first 7 years, we can pay our $25,000. There's no issue. Assuming we've set everything up correctly, we can even pay that $25,000 year 8, 9, 10, 11, and so on as we go down the line. But let's look at year 17. So year 17, we make our $25,000 payment. We have years 18, 19, and 20 remaining with our $750,000 term rider. But after that, starting in year 21, we're going to lose the term rider. We're going to have a reduction in death benefit. Term rider is going to go away. Our death benefit is going to be reduced by $750,000. If the new maximum allowable premium that we can pay into our whole life policy after losing this $750,000 is less than any of the premiums that we have paid in years 17 or 16 or 15, or the premiums we end up paying in years 18, 19, and 20, even if that new premium is some ridiculous number, like $24,750, we will have violated the modified endowment contract test because we're still inside a 7-year period here. Now, we've run into a number of people in this situation. They have this problem. They own one of these whole life policies. They've been paying premiums for a number of years. They're getting close to the terminal date of their term rider. And they looked at an in-force illustration that showed them that, hey, do you know that in year 21, you're going to have a modified endowment contract on your hands? And they come to us saying, what is this all about? And we have to go through this explanation here. Then, of course, they ask the obvious question, what do I do to stop this reclassification of my policy into a modified endowment contract? And for all of the companies that we have reviewed that have these style term riders on them, the answer is nothing unless you want to buy a new policy. Because the insurance company cannot extend your term rider. The contract that they wrote that needs state approval functions this way, and they can't just add additional components to it. That's not allowed. And they can't refund premiums that have violated the MEC test once the death benefit reduction becomes effective, not at least if they happened a year or two ago, because they can't just refund premiums from years past. There's some capacity to do this with universal life insurance contracts. I'm not aware of any capacity that allows it for whole life insurance. So the strategy, the consequences are you either live with the fact that you're going to have a modified endowment contract in a few years, or if you're healthy enough, you're going to have to buy a new policy and transfer this cash via the 1035 exchange into that new policy and simply not design it this way again. So what should you do if you own one of these policies? The first thing you must do is get an in-force illustration that should be able to verify for you whether or not losing the term rider is going to cause a violation of the modified endowment contract test. If it is, it's time to take action. Alternatively, if you don't own one of these policies, but somebody has proposed one of these policies to you, walk away. I don't think this one's worth trying to salvage. Yes, there are arguably ways that you could go about putting one of these policies in force and not having a problem with the modified endowment contract test. But that's a whole lot of extra worrying that you need to do when there's really no need to do it, because there are lots of other whole life options out there that don't do this, and they're great. So whatever small advantage somebody has claimed you might get by virtue of this specific policy with this specific feature that is a possible train wreck on your hands, it's just not worth it. I've been around the insurance industry for a long time. I am very intimately familiar with all the whole life products that are in the marketplace for the sake of trying to optimize cash. I can tell you not a single one of them is a top tier option that has this sort of term rider option. Now, some of the better options do have a term rider feature like this available, but they have other term features that you can use. Use them. There's absolutely no reason, no benefit to be gained from these level term riders at those companies. Simply put, the risk is too large that you run into a modified endowment contract that you cannot stop from happening, and you do not want that to take place. And if you feel like you can't get adequate answers from whomever has made that recommendation to you, of course, you're always free to come to us and talk to us about what you're trying to do with life insurance, and we can totally set you straight. I hope we've helped some people avoid a big headache. Thanks for hanging out today. We will see you next time.